This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hi, welcome to the latest edition of the AJ Bell Money and Markets podcast. I'm Dan Coatsworth, and joining me this week is Tom Sieber. Hi there, Tom.
Hi, Dan. Yep, lots of stuff going on in the markets this week. So we'll be chatting about some of the big companies who've been reporting, like Guinness maker Diageo, sausage roll giant Greggs, and a trio of American firms which have given us a fascinating insight into the state of the US consumer.
Now, Marks & Spencer has been all over the news because of its cyber attack, and the retailer has now issued its financial results, which give some insight into the scale of the problem. So we'll chat about M&S later in the podcast. We'll also hear from Ian Lance, who helps to run the Temple Bar Investment Trust, and that is one of the big shareholders in Marks & Spencer's at the moment.
There was also a big development in the world of buy now, pay later, which we'll discuss on this week's podcast, as well as some good news on scam victims getting their money back.
Now, we've got a really interesting take on the UK property market, as we've got some figures showing the hotspots for US residents looking to move to Blighty.
There's both good and bad news if you've got money in cash ISAs, as we'll discuss later on.
Now, after last week's superb chat around tariffs and weight loss drugs, Emily Barnard from the Edinburgh Investment Trust is back again with the second part of her interview. So this week, Emily is going to look at GSK and AstraZeneca, comparing the two companies and explaining why both of them tick the right boxes for her as an investor.
So lots of great stuff to talk about. Let's start with what's been going on in the markets.
I think we have to start with US Treasury yields hitting 5%. So, US Treasury yields, for those who aren't familiar with it, this is US government bonds. So we had the yields on the 30-year US Treasuries. They hit just over 5% at the start of this week. So that puts the country's long-term borrowing costs at the highest point since November 2023. And really, so in a nutshell, this means that the US government long-term borrowing has gone up. It's been fueled by the credit agency Moody's stripping the US of its AAA credit rating, and the concerns about Donald Trump's massive tax and budget bill and what that means for the government's mounting debt burden. So all of this has sort of troubled the markets a little bit. We had a bit of another wobble on US equities, and partly because higher treasury yields, they feed into the discount rates used by investors to value companies' present value of future cash flows. This is all about particularly things like tech stocks. A lot of the excitement the investors get in them is about what they could potentially make in the future rather than sort of at the moment. So we call these jam tomorrow stocks, and they get hurt when discount rates have big changes because of what's going on in sort of the government bond market. So really, we've got a situation here where yet more things are troubling people around the US. Lots more people looking elsewhere in the world for opportunities. And this is a key reason why European shares have done pretty well this year, much outperforming the US. And I guess we'll come on to these later, but it's certainly we've seen continued divergence in fortunes for US, certainly versus Europe and the UK. So obviously we've had that troubled markets, but Tom, as we're recording this, we've just had some figures out on UK inflation stats. So what's been going on there?
Yeah, so if we move across the Atlantic, I think the fact that inflation figures would be higher in April was probably one of the worst kept secrets in the world of finance, to be honest, because you had these long scheduled increases in energy and water bills, and they were a big factor behind the upward shift in the rate of inflation to 3.5%. Now, these should have a fairly temporary impact because obviously these big increases in April, that they may come next year, but they're not going to come in May or June or months going forward. So that might not be of too much concern to the Bank of England or too much interest to the Bank of England when it's weighing its decision on interest rates. But they might be a bit more concerned that there's some evidence of rising food prices. Looking forward a little bit, you've got the fact that oil prices are falling, partly because the Trump administration's tariff policy is seen as potentially constraining global economic growth. And that might help, obviously, as energy costs come down and the price of petrol comes down at the pump. But another thing the bank, I think, will be watching for is any evidence of renewed inflationary pressures in the services space. So particularly for things like staying in a hotel or having a meal out, because the employers in these sectors are really contending. You know, they're industries where you have quite a high volume of workers. So they're heavily affected by the changes in last year's budget to national insurance contributions from employers, and also the increase in the national living wage. So I think that they're the areas that might be sort of concerning, or, you know, more of interest to the Bank of England when it's thinking about its decision making, perhaps more than these increases in energy and water bills that had been, like I said, quite well flagged.
Yeah. Obviously, we had the sort of what's been going on in the bond market, what's been going on in the economics, but we had quite a lot of company news over the last week. I wanted to talk about Greggs. So, Tom, everyone's chatting about this viral mac and cheese. Please tell me you're one of these people who have raced to the shops to buy it.
I can happily tell you that I haven't sampled Greggs mac and cheese yet. I'm not saying, I'll never say never, but it's not high on my agenda, I've got to say.
I think it's really interesting. They've come out with, you know, the latest update, and they say things are starting to pick up a bit, because it's gone through a bit of a wobbly patch. Growth wasn't as strong as perhaps people previously thought it was capable of doing. It's now come out and saying, like, you know, things like this mac and cheese, everyone's talking about it on social media, pizza boxes, chicken goujons. I mean, is this the Greggs that we know? I know people call it Greggs the baker. I know it's not really its name anymore. It's not a baker, but its roots are baking, isn't it? I always think it's a really good place. You want to go, you're going out to the shops, you want to have a nice cup of tea, go and have a Belgian bun or a sausage roll or something. But, you know, if it's doing pizza and, you know, all that sort of stuff, it just, to me, it's like, well, you know, what is it? What is Greggs? This is not, its identity seems to be, it's evolving into a kebab shop. So I just think it's a bit of an odd one. And, you know, personally, I mean, I don't run Greggs, but as a sort of a commentator on this area, I think it's going down a very peculiar route. And, you know, I could see in, say, you know, a few years' time, it might say this is not quite worked for us. Yes, it's got a lot of interest on social media now, but these things are very short passing fads. But if you get like a viral hit, so it's come out. The shares, they're perked up on the outlook. You know, people are saying, okay, fine, it's not as bad as perhaps we thought, but this is a business which is facing extra costs from employment related stuff. It's investing in logistics, investing in more stores, investing in manufacturing. A lot of spending going on here. And it's kind of taking the assumption that there's still significant demand for more sites across the UK. So to me, it's like I increasingly are becoming a little bit more skeptical of where Greggs is going, because I thought it nailed a perfect sort of recipe for how it managed to stand out from the crowd. Now it's sort of blending into an area which is very, very, you know, highly competitive. You know, even places like Domino's Pizza are doing these sort of you know, fast food style lunch offers as well. So yeah, I don't know. Prove me wrong.
Yeah, I mean, maybe they will, but I can totally see where you're coming from. I think, you know, there was a lot of excitement when they released that vegan sausage roll, but you could see how that was, in a way, sticking to what they've traditionally done, but kind of expanding their potential sort of customer base quite significantly to people who wanted plant-based options or whatever. But you're right, moving into sort of completely different kind of categories of foods, you do wonder whether that kind of muddies the waters and then what is Greggs anymore. So I think that's a fair observation.
Yeah. Should we talk about Diageo? So perhaps best known as Guinness maker and Johnny Walker on the spirits side.
Exactly, yeah. So they, when I was going to introduce them, they were the two brands that I had in mind as well. So, yeah, I mean, Diageo is a company that's had quite a rough period for, you know, a couple of years at least. So, yes, it has this kind of enviable portfolio of big brands. It's also got, you know, a really large distribution network. It's got quite strong marketing capabilities as well. But since the then chief executive unfortunately died in June 2023, and it was shortly before he was due to step down anyway, actually, and be replaced by the current CEO, Deborah Crew, an American. Diageo served up a number of profit warnings. Its results for the last kind of full financial year, so that was to the end of June 2024, were well below consensus expectations and saw group sales decline for the first time since the pandemic. And there were several kind of things affecting the business. So it had excess inventory in the Latin America and Caribbean region. So, partly that was the company's fault for not planning things properly. It's been impacted by China having a slower than anticipated recovery from COVID. Particularly, I guess, in the whiskey, that's had an impact on the whiskey market. And, the consumer environment in North America has been quite uneven as well. And there was quite a lot of concern that the introduction of tariffs would really hit, we had another negative for a big global business like Diageo. But the results, these recent results, were pretty reassuring, or certainly, the latest trading update. So there was a 5.9% jump in third quarter organic sales. And that may have been a bit inflated by pre-tariff kind of order phasing, so people bringing forward their orders ahead of tariffs coming in. But there was also some relief that it reiterated its full year guidance on organic sales growth and operating profits. And it's still expecting to deliver a sequential improvement in organic sales growth in the second half. So consistently improving that growth. And it has quantified to some extent the impact from tariffs. So it's talking about taking a $150 million hit, which in the context of a company the size of Diageo, it's obviously a lot of money, but it's not a huge sum. And it's talking about being able to mitigate around half of that profit impact on an ongoing basis. So that was the numbers, but maybe even more significantly, I think investors got excited about the first phase of Diageo's Accelerate program. So, I feel like I've heard the words accelerate used quite often in relation to company turnarounds and recoveries, but they're talking about boosting free cash flow, lifting margins, also talking about cutting costs, so taking some $500 million worth of costs out. So again, that's quite familiar messages that you get from a company when they're looking to turn around a business. But I think perhaps, again, even more significantly than that, there were comments from the company that they're going to look at some potentially significant disposals. And I think that was interesting. The company pointedly said it wasn't, just going to restrict itself to just trimming the portfolio. So that suggests they might do something quite meaningful. And, that's raised the question, I guess, in some quarters, whether they might sell Guinness and the other beer brands that they own and focus purely on spirits. And that might be well received by the markets because typically spirits, generate higher returns. So it would improve the company's margins, and that might mean it attracts a higher valuation from the market as well.
Yeah, it's an interesting one, isn't it? I saw some suggestions that of what it could sell. It was really wide ranging, even talking about potentially selling some spirit brands. So it's. But I think I listened to a little bit of the sort of the conference call that the company did, and they were saying that no matter what it does, the type of deals it's looking at are fairly chunky. Therefore, they could take quite a while. So, it's guiding that these things won't happen until, potentially for another 2-3 years before they complete. So I think anyone perhaps listening to this or having read its latest update, thinking that we'll get a big announcement, something real big news, I wouldn't hold your breath. It could be
that's a really good point. And they won't want to rush it because obviously they want to achieve the best possible price. And, I guess they're not a panic station. So I think, that's probably sensible from their point of view. But yeah, it might generate some disappointment in terms of kind of the excitement that you initially got this week.
So obviously, Tom, you put a number on the hit tariffs on Diageo, 150 million. But we've also had another company which is sort of quantifying a hit in a different way. So this is Marks and Spencer. So it's talking about what is the current estimate of hit to profit from its recent cyber attack. So I think if you've tried to order anything from Marks and Spencer's website since late April, you haven't been able to do that. All online orders are paused. If you've gone into shops for a little bit, there was quite a lot of gaps on the shelves. That seems to be sort of being resolved now, but it's basically come out and said 300 million potential hit, and that might not be the final figure. That doesn't factor in any money it could potentially get back from an insurance claim. I've seen some suggestions that it might get 100 million back. There's some other stuff it could do as well, but there is still an unknown regarding essentially fines from an outfit called the Information Commissioner's Office, the ICO. That's the sort of the enforces data protection regulation, and it essentially looks to see what steps companies have done to, first and foremost, protect customer data and the sort of very sensitive data, and then what it's doing now to deal with problems. Really wants to make sure that companies are proactive and taking appropriate steps to prevent data breaches in the first place. So the maximum fine that the ICO will put on a company is either £17.5 million or 4% of global annual turnover. So, but it takes the highest of the two. So now Marks and Spencer's just come out. It's reported £13.8 billion in annual revenue. So 4% of that figure, £552 million. So I think looking at some of the other situations, like British Airways is perhaps a good example. That was facing a fairly chunky fine from the ICO, it managed to get only got fined a fraction of it, relating to a data issue. But this is because the ICO said, look, this happened during the pandemic, and we sort of take into account your financial circumstances in sort of a delicate situation around all businesses at the time. So there's still some unknowns there. Now, Marks and Spencer's come out and said it's not going to be potentially until July that it seems sort of online sales sort of being switched on and back to normal. So there is a suggestion there's still more impacts to profit here. So unsurprisingly, it's talking about, it was already going to upgrade some of its infrastructure, but it's going to bring that forward. So more spending sooner than previously suggested. So there's lots of things it's trying to do behind the scenes. So I think this situation seems to, we might have turned a corner in terms of it might not get me really severe. Maybe it seemed pretty confident in its figures. And commentary around the results, but it could still, the impact of it could still trickle on. So I was talking to Ian Lance. He is a fund manager at Temple Bar Investment Trust. So Temple Bar is managed by asset manager called Red Wheel across various funds and trusts that they look after. They are a chunky investor in Marks and Spencer's. So we'll have a full interview with Ian on next week's show. We talk about lots of really interesting stuff to do with UK stocks and UK stock market. But I wanted to just play this quick clip now. I wanted to, it's worth pointing out, I recorded this with Ian the day before the Marks and Spencer's results came out. So he wasn't aware of, this figure that they put onto it. But I just wanted to give you a sense of, from a shareholder's perspective about how he was thinking, what's happened with M&S and what's the sort of knock-on effect. So let's just hear this quick clip from Ian now. Now, you got a stake in Marks and Spencer. Obviously, as we're recording this, it still is in the middle of trying to deal with the cyber attack. I imagine by the time that people listen to this episode, we might have had more development and more information about what's going on. But I guess longer term, what does it, what we've seen recently really mean for this business? Do you think that, customers perhaps won't trust it as much? They're worried, because normally with a cyber attack, you hear about a bit of disruption and then it's business as usual in a couple of days. But we're weeks into this situation with M&S, aren't we?
Yeah, it undoubtedly has taken, it has taken a long time for them to get things back to normal. The sense I get is that things now are starting to return to normal, particularly with regards to sort of logistics and warehouses and so on and so forth. The one part which still isn't is their online business. I think online sales are about a third of their clothing and home sales. So that is pretty significant. So what does it mean? This year, undoubtedly, it's going to cost them money. It will, there are going to be the lost sales. there's going to be all the costs of actually dealing with the issue. I think longer term, hopefully, it doesn't mean anything. The company actually prior to this was actually starting to get some pretty strong momentum, both in their food business and in their clothing and home business. They continue to take market share. Those store transformations that they're doing are really delivering. So and I think they are now just increasingly relevant with the consumer, aren't they? I think people, whether it's their clothing range or whether it's their food, people like Marks and Spencers, and they are choosing to spend their money there. So my hope is that we get back to some sort of normality within the next few weeks. And as we get over that, so the transition can continue, albeit that it undoubtedly is going to cost them money this year.
So that was Ian Lance I was talking to earlier this week. And we'll have the full interview with Ian on next week's podcast, where he talks about things like ITV and Shell and lots more interesting UK stuff. But before we sort of finish up on Marks and Spencers, I just wanted to point out that there was an announcement from a home furnishings company in America called Pottery Barn, saying it's going to launch in the UK later this year. It's only going to be online, but I think this is quite interesting because if you think Marks and Spencers, whilst everyone knows it for clothes and food, it's also really big in home furnishings. In that space, it also operates with Next, with Dunelm. All three of those companies are facing now. I think you shouldn't underestimate the competition from Pottery Barn coming in. It might not be that well known in this country, but it is really well known in the States, and so it's something to keep your eye on. But I think on the subject of obviously US stuff, I know, Tom, you've been looking at some of the US retailers which have been reporting this week. So who have you been hearing from?
Yeah, so I think it's quite a mixed picture, really, in terms of US retail this week and how healthy it suggests the US consumer is amid all the kind of noise we've had around tariffs and any impact that might have on US households. So Home Depot, which is a huge home improvement chain in the US, came out with what was probably quite a reassuring set of numbers, really. So it stuck with its guidance. And what was, I think, really notable was that it said, having kind of diversified its supply chain, it didn't have any plan to raise prices in response to tariffs. And given you had the world's biggest retail, Walmart, delivering exactly the opposite message last week, I thought that was quite striking. And we had another home improvement name, Lowe's, which also kept its guidance in place. So you're getting some kind of suggestion there, I guess, that Americans are still feeling confident enough to spend money on doing up their homes, they're prioritizing that potentially. So that's interesting. And I think whether or not that can continue might depend a bit on the health of the US property market, given spend in this area is obviously pretty closely linked to this. When people move, they like to do up their homes. When people are looking to sell a house, they've got a similar sort of push to make their homes more attractive and then easier to sell. So I think those two things were quite significant. And then it's what we were talking about earlier, really, the increase in the 30-year Treasury yield is probably not quite that helpful in terms of the US property market, because that yield, that level, is quite closely associated with where the mortgage rates sit. So that was interesting, and I think it'll be. I think people will be watching the next quarterly updates quite closely to see if they kind of still feel confident enough to stick with their guidance. And it was a very different picture at Target. So this is a more of a discount retail kind of variety chain, I suppose you would call it. Sells lots of different types of products. And that saw sales falling more than expected in the first quarter. And they were really gloomy about the rest of 2025 as well. So they're kind of warning that sales will continue to slip for the remainder of this, for its current financial year. And what they're saying really is that they've seen that customers are worried about the impact of tariffs and what that might mean for the economy, and they're pulling back on their spending. They also flagged that they've been affected by customer boycotts, and that has done some damage in the latest quarter. So people might have seen that this has been a bit of a trend, particularly in the US, but the company scaled back quite a lot of its diversity, equity and inclusion initiatives, often sort of shortened to DEI, in January, having come under attack from conservative activists and the White House. So yeah, quite a mixed picture really from US retail, but I suppose, perhaps not as negative as you might have expected, given, all the talk about a recession and what impact tariffs might have.
Yeah. Well, thanks, Tom. Let's shift gears and sort of chat about some personal finance stuff now. I wanted to, first of all, talk about buy now, pay later, because the government has announced some new rules aimed at protecting shoppers who use these services. So under the legislation, lenders will have to carry out affordability checks to stop people taking on too much debt, and also getting faster access to refunds. So I think about 1 million people in the UK estimated to have used buy now, pay later last year. But there definitely been fears that people are spending more than they can afford. So actually, we had a report out from the UK financial regulator, the FCA, the other day, and it was looking at just general trends with what people do or with money and the sort of attitudes towards it. And actually, they found that the number of people using buy now, pay later had risen significantly in sort of recent years. It said actually 40% of lone parents, 35% of women aged between 25 and 34 use these products. So I guess, we get these new legislation. It comes into effect next year. So really, it will see the providers of these services will have to follow consistent standards so shoppers know exactly what they're signing up for, whether they can actually afford the purchases, and how to get help if needed. So this does mean sort of upfront checks on affordability. And I think, the right to complain to the financial ombudsman. So all in all, I guess we've been expecting regulation, well overdue regulation in this sort of area. And, this seems like a pretty, sensible next step in sort of the evolution of making sure that people aren't getting into too much debt by using the buy now, pay later services.
Yeah, absolutely. I mean, I think that is the big concern, isn't it? That it kind of enables people to spend money they don't have on stuff they can't afford. Particularly, you mentioned the FCA data there. I think another line from that was that 1 in 10 people don't have any cash savings at all. So it's, you can see how it's quite precarious for some people. And in that context, there's been some news this week about the launch of a so-called prepaid shopping card loan from a charity-owned lender called Fair for You. They partnered up with some retailers like Argos, Iceland, Dunelm. And what they're offering essentially is a card that customers will be able to apply for a credit limit of up to £350 on. And that money is then loaded onto this prepaid MasterCard that can be used to pay for purchases in store, but also online with the retailers it's partnering with. And once users have nearly paid off the balance, they can apply to top it up. And I think what they're trying to do here is help people who can't get kind of mainstream credit cards, can't even get buy now, pay later. And I guess that might become more difficult if the government's increasing regulation, because they'll try and limit access to people whose financial circumstances aren't sufficiently robust to kind of be able to use that kind of credit responsibly or in a way that doesn't get them into trouble. And because this is a charity, backed lender, it's wholly not for profit. They're not trying to make money out of people. So I suppose they will be able to treat these people in kind of quite a responsible way. And, they won't be charging them lots of extra commission or kind of heavy interest rates. So it's an interesting development and one to watch.
Yeah. Okay. I want to talk about scams, because we've had some news saying a high proportion of scam victims are actually getting their money back. This is since new mandatory fraud reimbursement rules were launched last October. So talking here about, it's called an authorized push payment scam, essentially a bank transfer scam. So it occurs when you send money from your bank account to one that actually belongs to a scammer. So, for example, a scammer may call claiming to be from your bank's fraud team. It warns you need to move money to a safe account. However, what you actually might be doing here will be sending money to an account that the fraudster can control. So, since the 7th of October, these cases will be handled under new rules where there'll be faster payment providers, which is most UK banks and building societies, have to follow these rules. So banks have to give people their money back when they've been tricked into transferring it to criminals. The reimbursement limit of £85,000 has been applied under the rules, but banks can actually go further and repay higher amounts. And so the consumer services outfit, which has actually got some really good advice on what to do if you're in this situation. You think you might have lost money to a bank transfer scam. And so it says you really go notify the bank or payment provider that you hold your account with. Call your payment provider using the number found on the back of your card or a recent statement and tell them what's happened, and also provide the account details that you've sent the money to, because the bank might be able to stop this transaction from going ahead or actually just recover your money from the fraudster's account. And it's important to be quick with this. So tell your payment provider as soon as you suspect you think you've been scammed. I think it's probably also helpful if you contact the bank that you've sent the money to as well. So you can check which bank you sent the money to by looking at the receiving bank's sort code, because each bank will have a different sort code which it can then be identified with. So obviously, scams are unfortunately becoming very widespread, commonplace, and the finance industry is working very hard to try and clamp down what is going on here. There's lots of things going on to try and protect people, but you do need to stay alert to these situations and, say act fast if you suspect you think you've been a victim to it.
So a bit of a change of gear. Thanks for that, Dan. From that, people might have seen possibly the news that one-time chat show host Ellen had moved to the Cotswolds after the election of Donald Trump. And it looks like it's becoming a bit of a trend, according to some recent figures out from Rightmove. So the number of Americans looking to buy homes in Britain has reached an 8-year high. So presumably being driven by sort of growing uncertainty around politics and the economy at home. And inquiries in the US have jumped 19% since the start of the year compared to the same period in 2024. And it's the highest level of interest they've seen since 2017, when, perhaps not coincidentally, Donald Trump first took office. What's quite interesting is, I suppose, often you'd assume that this would all be directed at London, but for the first time, Edinburgh has overtaken London as the most popular location for US buyers. So around 28% of all American inquiries were focused on Edinburgh, compared to 26% for the nation's capital.
Yeah, I think it is interesting. I mean, we seem to have this sort of obsession with the property market generally. I just in the UK, I think it's always quite fascinating to whilst we talk a lot about mortgage rates on the podcast and sort of property market trends, but it's interesting to take a different take on it. And we were mentioning earlier about lots of people potentially looking at different places than just the US for investments, whereas the US used to be really popular. To also see people in the US look elsewhere for places to live is very interesting as well. Really, it's an indication of the sign of the times that we're currently living in, isn't it?
Yeah, it is. It is. I mean, I wonder if once they experience the weather, they might think twice, but
yeah. Well, thanks, Tom. Before we bring on our last guest, I just wanted to flag some stuff around cash savings rates and cash ISAs. There was a lot of speculation that Chancellor Rachel Reeves was going to reduce the £20,000 limit on money that can be put into a cash ISA each year. But actually, we just before we were recording this, there was an interview broadcast on the BBC where Rachel Reeves was asked whether, in a few years' time, someone would still be able to put a whole £20,000 a year into a cash ISA, and kind of, Rachel Reeves gave the indication that she wasn't going to lower the level, and this is sort of slight change. So we haven't actually got sort of official lines on this at the moment, but I think it sort of draws the conversation on to cash savings, and should people be putting more money into the stock market instead if they're able, they've got time on their side to take higher risks. Because Tom, I know that you've been looking at trends with interest rates, and obviously that and what that means for cash ISAs. I think that yes, in the last couple of years we've been able to get decent money on any sort of savings in the bank, decent interest. That's clearly changing now, isn't it?
Yeah, thanks, Dan. So yeah, we've had some data out from Moneyfacts UK, which shows that the average fixed rate bond and ISA rates fell across the board month on month. And that's the first time that's happened in 6 months. And the amount of product choice overall also fell. So there's something around 2,200 savings deals, including ISAs, available right now. But wasn't all bad news. The choice of cash ISAs actually rose to a new record high, and the number of savings providers also ticked up. So that's just there's still some kind of fairly healthy competition in this market, which might help with rates. But we did see falls in the 1-year fixed bond rate. So its biggest monthly fall since October last year. And the average longer term fixed bond also fell by its largest monthly amount since September 2024, and saw sort of similar trends as well in fixed ISA rates. So yeah, there is some sign that the cut in interest rates is starting to feed through into the savings market.
Perfect. Well, thanks, Tom. So obviously we just got one more segment to run for you this week.
Yes, exactly. It's time for this week's big interview. So anyone who listened to last week's podcast will know that we had Emily Barnard from Edinburgh Investment Trust on the show talking about tariffs in the pharmaceutical sector. There was so much to talk about that we had to splice the interview in two, particularly as tariff news has been fast moving in that industry. So the core part of the chat about AstraZeneca and GSK is going to be in this week's episode. Emily is a fund manager and she holds both of these stocks in the Edinburgh Investment Trust portfolio. If you've ever wanted to get a bit more information about exactly what these two companies do, where they've come from and where they might go next, you're going to get that right now. So without any further ado, here's the rest of Dan's chat with Emily, which they recorded earlier this month.
So I'm very pleased to be joined by Emily Barnard from Edinburgh Investment Trust. Emily, great to have you on the show. How are you doing?
Good morning. Thanks very much for having me on.
Excellent. Well, thanks for coming on. I've been looking for someone for a while who can talk to me about AstraZeneca and GSK. They're really popular holdings with a broad range of investors. But I'd like to learn a bit more about these companies. So first of all, I mean, perhaps could you just sort of give a top line view about why is it that you've decided that these stocks are a good fit for the Edinburgh portfolio?
Sure. So there's sort of two parts to that. The first would be about the individual companies in question. So actually, we think that both GlaxoSmithKline and AstraZeneca are both interesting investments standalone for different reasons. And the second part is really the role that they play. So with the Edinburgh Investment Trust, we think about building, we've got about 40 to 50 positions, and we think about building well-balanced, diversified, and all-weather portfolios. So kind of all economic weather portfolios. And pharma companies can play an important role in that. They're generally more defensive. Their earnings are generally not so exposed to the economic cycle. So they're both interesting individually. And then when you think about constructing a portfolio, they can be, quite nice defensive companies to own. We can go on to talk about them in detail, kind of a bit more. So maybe start with AstraZeneca. There's sort of three things to think about for AstraZeneca. There's track record, growth outlook in the future, and then what are the risks around AstraZeneca? Now, the track record is really, really exceptional for AstraZeneca. It's an exceptional track record of R&D innovation and really research and development, and then the commercialization of new drugs is the lifeblood of a pharmaceutical company. And AstraZeneca's built up really strong positions. So cancer medicines, oncology is about 40% of the business. Biopharmaceuticals, so think heart, lung, liver, kidneys, another 40% of the business. And then rare diseases, 20%. They've got really strong positions in all of these. But what's interesting is AstraZeneca has a very strong track record, but this wasn't always the case. So if we go back 11 years to 2014, AstraZeneca at that point rejected a takeover bid from Pfizer, the US pharmaceutical company. Now, the current CEO, Sir Pascal Soriot, at that point, he'd been in situ for, I think it was around 2 years, and he had the task of refilling AstraZeneca's pipeline of drugs. So at that point, AstraZeneca had some looming patent expirations on a number of really big blockbuster drugs, which would put revenue and earnings growth at risk. So it's really important to refill that pipeline. So they rejected the Pfizer takeover bid, and they put out what at the time was a pretty ambitious target. So revenue in 2014 for AstraZeneca, it's around the sort of $26 billion. And they came out at an investor day and said, we've got a target of $45 billion in 2023, so just under 10 years later. To go from 26 to 45 in 10 years is quite an ask. Well, they succeeded. Fast forward to 23, and we hit just above that 45. So it's a really impressive track record. And actually, if you were a shareholder for 10 years, ending at the end of 23, your total return from owning AstraZeneca shares would have been above the S&P 500.
Wow, that's pretty good, isn't it? Yeah.
It's a really incredible track record. So they both delivered kind of operationally, they've delivered financially, and they've delivered for shareholders. So great track record. That's all in the past. What is the growth outlook now for AstraZeneca? They followed up their 2014 Investor Day with another one last year up in Cambridge at one of their big strategic R&D sites and released a new revenue target. So the target now is to go from about $55 billion of revenue today to $80 billion in 2030. So if they are successful at doing that, we should see revenue grow about 7% a year for AstraZeneca. Earnings should grow a little bit faster than that. And then they pay a dividend as well. It's about 2 to 3% dividend yield, but there's definitely room for that dividend to grow. Notwithstanding, actually, a recent step up in capital expenditure. So they're investing in facilities globally, and that's going to push CapEx up a bit, but dividend still quite a lot of room to grow. So actually, the growth prospects for AstraZeneca, really interesting, nice prospective total return. And total return is something we really think about, the Edinburgh Investment Trust. So both growth and yield. And for that nice total return, you're paying today about 14 times price to earnings ratio for AstraZeneca. So actually a valuation that doesn't feel too expensive for the potential growth on offer.
So I guess that if you compare that to GSK has always seemed to be, everyone sort of said, oh, look, it's always been a lot cheaper than AstraZeneca. And is that partially because it's not been as successful as a business, or inconsistent? Is that a good way to describe it?
Yes. So GSK is, whereas Astra is about 14 times, GSK is about 8 times price to earnings at the moment. It's a function of a few things. The first is, that stellar track record we've talked about for AstraZeneca. GSK doesn't have quite as good a track record. I can kind of come on to why. The growth outlook also isn't as exciting as AstraZeneca. And so it's trading on a lower valuation. It's interesting. AstraZeneca almost has, the burden of living up to its own history, whereas GSK doesn't quite have that. So the history of GSK is quite an interesting one. And I think you've got to go back about 20 years or so when GlaxoSmithKline merged with SmithKline Beecham. So this is sort of 2000. And prior to that, SmithKline Beecham was actually the merger of kind of various pharmaceutical companies. And what happens is you merge R&D teams, things in different teams are done slightly differently. You get a bit of disruption to R&D, productivity drops a bit, you have some retention issues with scientists. Now, this is long in the past, but pharmaceutical companies operate on quite long research and development timeframes for drugs. So your average drug might take somewhere between 10 and 15 years to go from discovery through to commercial launch. And so actually disruption to R&D teams in what might seem quite a long time ago actually still had an impact within GSK for quite a few years. They also, and this is historically, commercial performance was a little bit kind of below potential. There wasn't as much joined upness, if you like, between R&D and between the commercial teams. Now, actually, again, that's history. I think a phenomenal amount has changed at GlaxoSmithKline. Across people, you've had management change, you've had a lot of change at maybe the kind of second layer down, so kind of top leaders in the organization. The R&D approach has been kind of streamlined. So they spread R&D a bit too thinly across a lot of areas. They've kind of focused this down, streamlined it. You've had an increase in phase 3 pipeline assets. So these are assets which are in sort of the last stage of clinical trial just prior to launch. And so that's a really encouraging signal of kind of future growth. They've improved their commerciality. So many years ago, they were in about, I think it was 140 countries. They've slimmed that down to 70. So generally, they've done a lot behind the scenes to improve the way GSK operates. R&D has been improved. Pipeline is much improved. So yes, lower valuation than AstraZeneca. The track record is not as good. The future growth outlook, where AstraZeneca, if they achieve their targets, it's about a 7% growth. GSK have also put out targets, and it's probably more like 4% revenue growth, give or take, a little bit more than that on earnings, medium term, lower than AstraZeneca, but it does have a higher dividend yield, so higher cash returns to shareholders. So again, GSK actually, a different composition of returns, more on a dividend yield, maybe slightly less on earnings growth, but again, a really attractive total return, we think.
So what is GSK sort of focused on these days? Because I guess if you're an investor in the pharmaceutical sector, you kind of want exposure to lots of different things. But even AstraZeneca and GSK and all these big pharma guys, they're all specialists in certain niches, aren't they? Where does sort of GSK sort of fit in sort of the picture?
So where they've got real areas of strength, I'd say, would be in what they call specialty medicines, which we can kind of come on to, and vaccines. So about 40% of GSK's business is in what they call specialty medicines. About 30% is in vaccines, and 30% is in what they call general medicines. So the general medicines bit is, they're guiding to it being roughly stable. And the kind of growthier areas are specialty and vaccines. So on specialty, the vast majority of that is their HIV franchise. And they've had a really, really strong HIV franchise. And this is actually also linked to one of the main risks for GSK. And it's a risk you see across pharmaceutical companies, and this is patent expiries. So give or take, once a drug is launched, it tends to have around 10 years of exclusivity on the market, give or take a couple of years. And then you reach what is called a patent cliff, and generic manufacturers come in with their own versions of your drug. It's a lower price, and you can kind of get relatively significant drop off in revenue. And GSK in their HIV franchise have a number of patent cliffs starting 2028 through to 2030, which again, it is a few years away, but obviously, again, these are long cycle research and development. So you have to think about these things in advance. And so they've been doing a bunch of R&D. They've got now within the portfolio what they call their long-acting portfolio. So traditionally, HIV treatment has been daily oral medication. And GSK, alongside others in the industry, have been innovating and have come up with long-acting medicines, long-acting injectables for both treatment and prevention of HIV. So the newer growing part of the portfolio is actually 4 monthly injections for treatment and for prevention. They've got pipeline studies looking at can they extend that to 6 monthly. So HIV, they've got real strengths there. It also contains one of the risks around patent expiries, but they've got some really interesting innovation going on. It's both better for patients, better for general lowering of healthcare costs, and good for GSK in kind of tackling some of those patent expiries. So HIV, real area of strength. Another area of strength is their vaccines business. But this is an area where medium term, really exciting. Short term, maybe a few headwinds, some of which related to changes we see in the US. So the vaccines business, the main ones of note, they've got a few in there, but the main ones would be the more recently launched vaccine for RSV. So this is something called respiratory syncytial virus, if I'm pronouncing that correctly. And it's quite a common virus, but particularly if you're younger or you're older or you have maybe a weakened immune system, it can actually be quite serious. And GSK developed and launched the world's first RSV vaccine for adults. And this was launched 2013. It's called Arexvy. And it's a real area of potential future growth. Where the shorter term headwinds are for Arexvy are around, and we can come on to this, but the US, let's say it's become a less favourable environment for vaccines in general with some of the more recent appointments, but real potential in growth outside of the US for Arexvy, so the RSV vaccine. And the other really good product they've got in there is a vaccine for shingles. So this is a vaccine called Shingrix. And again, real opportunities outside of the US for Shingrix, particularly in China. Slightly slower growth now in the US because they've been there for a few years. And so the population that are most willing to really go and get a vaccine and most in need of it have kind of got that already. So opportunities for Shingrix outside of the US, opportunities in will people need booster vaccines in a few years' time? That's a sort of unanswered question. And interestingly, these are not GSK studies. These are studies at kind of various worldwide universities. And it's a retrospective study looking at when a shingles vaccine was kind of mandated by the UK government. And the way in which it was done, there was almost a natural clinical trial that took place with certain age groups. And so researchers have been doing studies, and there's some suggestions that Shingrix can help lower risk of dementia.
Okay.
So again, not GSK studies, but maybe that's a potential future avenue of investigation. So HIV and vaccines, real areas of strength for GSK.
Thanks again to Emily Barnard for coming on the show. Don't miss next week's podcast, where we'll get the full interview with Ian Lance from Temple Bar Investment Trust. He'll be talking about some of the UK's best known stocks. And until then, thanks for listening. And just a reminder that we're now filming these podcasts, and you can find them by searching for AJ Bell on YouTube. See you later.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.